The Great Depression of 1929 to 1930s was the worst economic downturn in modern history. It started in the United States, but quickly spread around the world, affecting millions of people. During the Great Depression, prices were falling, which might sound good, but it was a terrifying reality. The stock market crash triggered a chain reaction. Businesses failed, banks shut down, and unemployment skyrocketed to 25%. At the same time, prices dropped rapidly in a phenomenon known as deflation. People were afraid to spend, businesses couldn't make a profit, wages were slashed, and the entire economy spiraled downward in a vicious cycle of fear and shrinking demand. Fast forward to today. We're living in the opposite kind of crisis: inflation. Over the last few years, everything has gotten more expensive: groceries, rent, gas, and even basic necessities like eggs. This time, it's not that people aren't spending, it's that their money doesn't go as far as it used to. Wages aren't rising fast enough to keep up with the cost of living. So even if you have a job, making ends meet feels harder and harder. This is what inflation looks like: a silent erosion of your purchasing power, where $100 buys you less each month, while your paycheck stays the same. Both deflation and inflation hurt in different ways. In the 1930s, people had time, but no money. Today, many of us have jobs, but can't afford a secure future. Back then, the fear was spending money you didn't have. Now, it's spending money that won't be enough. Two opposite problems, but the pain is just as real. And while history doesn't repeat itself exactly, understanding what happened then helps us make sense of what's happening now. So the question is, which world would you rather face? One where prices fall and fear freezes the economy, or one where everything gets more expensive and you're always playing catch up? The reality is that now prices are going up, and will it ever turn into a Great Depression? Since in the Great Depression, prices were falling instead of rising, let's clear up something first. A depression isn't defined just by prices falling. A depression is a long, severe downturn in economic activity. It includes things like very high unemployment, massive business failures, falling wages, low consumer spending, and yes, often deflation, falling prices. But deflation is just one possible symptom, not the cause or the definition. Right now, the U.S. is facing high inflation, which is the opposite of what we saw in the 1930s. Prices are rising, people are feeling the squeeze, and wages aren't keeping up. This can lead to a recession if consumers pull back on spending and businesses start cutting jobs. A recession is like a short-term economic slowdown. A depression, on the other hand, is deeper, longer, and more destructive. Could today's inflation turn into a depression? It's unlikely, but not impossible. For it to become a depression, the inflation would need to cause major economic shocks. Companies would need to lay off huge numbers of workers, people would stop spending, banks would tighten credit, and eventually the economy could stall out completely. If prices then collapse after a period of high inflation, like what happened in the 1920s leading into the 1930s, that's when deflation could kick in and things could spiral downward. But so far, we're not seeing that level of collapse. Instead, what's more likely is stagflation, a mix of high inflation, low economic growth, and rising unemployment. It's not as catastrophic as a depression, but it's still painful and hard to fix. So in short, inflation doesn't automatically lead to a depression, but if it's not managed properly, it can set off a chain of events that really hurts the economy in the long run. So let's do a comparison with today's economy. Did the 1920s start with inflation too, and then followed by deflation? The answer is yes. That was exactly what happened. The 1920s actually started with inflation right after World War I. Between 1918 and 1920, the U.S. experienced a sharp rise in prices. This was due to a combination of wartime spending, supply shortages, and a sudden surge in consumer demand after the war ended. Prices for goods and services rose quickly, creating inflation and a temporary economic boom. But then, in 1920 to 1921, the U.S. economy went through a sharp but short recession. During this time, the Federal Reserve raised interest rates to fight inflation, and prices dropped rapidly. This was a brief period of deflation. However, after that, the economy rebounded and entered what we now call the Roaring Twenties. From 1922 to 1929, the economy boomed. Consumer spending surged, industries like automobiles and construction exploded, and the stock market soared. But here's the catch. Beneath that surface-level prosperity, there were growing imbalances, overproduction, too much buying on credit, a widening gap between rich and poor, and excessive speculation in the stock market. Then came the crash of 1929. The stock market collapsed, banks failed, and demand dropped. That's when real, sustained deflation set in. From 1930 to 1933, prices fell year after year, deepening the Great Depression. So yes, the 1920s did start with inflation, shifted briefly to deflation, enjoyed a boom, and then ended with massive deflation during the Depression. Historically, the Great Depression in the 1930s happened because of a combination of factors: the stock market crash, widespread bank failures, poor policy decisions, and the absence of social safety nets. Today, our systems are much more equipped to handle shocks. Governments can inject money into the economy. Central banks can adjust interest rates quickly, and social programs exist to prevent people from falling into complete poverty. These tools make it much less likely that we'll see a full repeat of the 1930s. However, that doesn't mean we're safe from economic hardship. If inflation continues to stay high, if businesses start laying people off, and if personal and government debt becomes unmanageable, we could enter a prolonged period of economic stagnation. While this wouldn't be the same as the Great Depression, it would still feel painful for everyday people. So what should we do now? First, be intentional about spending. Tightening your budget and tracking where your money goes can make a big difference. Second, build an emergency fund. Even if it's small, it gives you breathing room if something unexpected happens. If someone gets laid off today and doesn't have an emergency fund, it can feel terrifying, but it's not the end. The most important thing is to take calm, focused action, even when emotions are running high. Take a deep breath. It's normal to feel fear, anger, or even shame, but remember, a layoff is not a reflection of your worth. It's a financial event, not a personal failure. The next step is to secure any immediate resources. File for unemployment benefits as soon as possible. Even if the amount feels small, it's crucial short-term support. Look into any severance pay or unused vacation days your company owes you. Then, shift quickly into survival mode. Go through your expenses line by line and cut anything non-essential: subscriptions, eating out, shopping, entertainment. Focus on keeping a roof over your head, food on the table, and your phone or internet active. If rent or mortgage payments are a concern, reach out to your landlord or lender early. Many would rather work with you than lose a tenant or go through foreclosure. Next, bring in cash any way you can. Sell used items online. Take on part-time gigs or freelance work. Every dollar counts right now. At the same time, start your job search immediately. Apply to everything you're qualified for, even roles slightly outside your comfort zone. If you're in a saturated field, consider short online courses or certifications that can help you pivot quickly into something in demand. Most importantly, protect your mental health. Losing a job is a loss, and it takes a toll. Set small daily goals, stick to a routine, talk to friends or mentors, and don't isolate yourself. You're not alone. Many people are in the same boat, and help is out there. You may not have an emergency fund now, but with the right moves, you can create one for the future. And while this moment feels scary, it could also be the turning point to something stronger and more sustainable. If you found this video helpful or comforting in any way, please consider giving it a like and subscribing to the channel. Take care, stay strong, and I'll see you in the next video.